Institutional integration of SpaceX into ETFs and mutual funds. Following the historic June 12, 2026 public debut of SpaceX, institutional asset managers have faced an unprecedented structuring challenge. With an initial market capitalization hovering near $2 trillion, SpaceX represents one of the largest corporate entities ever to enter the public markets. Yet for institutional fund managers, asset allocators, and ETF issuers, integrating this aerospace giant is not as straightforward as it appears. Today, we analyze the structural mechanics driving the fund ecosystem, which is divided into three distinct methodologies: passive index constraints, active concentration management, and emergence of highly tactical single stock derivatives. We begin with the passive investment sector, dominated by mega-cap index tracking funds from Vanguard, BlackRock, and State Street. To understand why SpaceX is not yet moving the needle in core retirement portfolios, one must look to the mechanics of float adjustment. SpaceX entered the public markets with an exceptionally tight public float. Only approximately 5% of its total equity was made available to the public. The remaining 95% remains locked up by corporate insiders, founders, and legacy private equity vehicles. Because major global benchmarks weigh constituents based on free float market capitalization rather than total enterprise value, SpaceX's initial baseline weight in major broad market indexes is mathematically constrained to 1% or less. Furthermore, the inclusion in the S&P 500 remains a lagging catalyst. S&P Dow Jones indices enforce a strict eligibility requirement, demanding 4 consecutive quarters of cumulative GAAP profitability. While certain total market and technology benchmarks utilize fast-track provisions to add the stock within 15 business days of the IPO, standard S&P 500 tracking products must remain on the sidelines until public audited financials meet these statutory rules over the coming year. In contrast to the passive sector, specialized active managers and growth-focused mutual funds have long held exposure to SpaceX via private placement and special purpose vehicles. Asset managers like Barron Funds and ARK Invest have transitioned these legacy private holdings directly into their public portfolios. For these managers, the IPO has successfully unlocked massive institutional liquidity. However, it has also introduced a complex risk management challenge: regulatory concentration limits. Under the Investment Company Act of 1940, diversified funds face strict limitations, typically preventing any single asset from exceeding 10 to 15% of the total fund value. As the public market value of SpaceX experienced heightened volatility through June, surging past $200 per share before pulling back towards its $135 IPO baseline, these active managers have been forced to execute systemic rebalancing programs to maintain regulatory compliance. Finally, the public listing of SpaceX has catalyzed a highly aggressive wave of tactical single stock ETFs. Capitalizing on the immense public interest and trading volume of SpaceX, financial engineers launched several leveraged and synthetic products almost immediately following the IPO. Funds such as the Direxion Daily SpaceX Bull 2x ETF and the Defiance Daily Target 2x Long SpaceX ETF utilize complex swap agreements and derivative overlays to deliver 200% daily leverage exposure. Concurrently, income-focused managers have introduced covered call products like the Harvest SpaceX Enhanced High Income ETF, designed to monetize the stock's steep implied volatility to generate monthly yield. Institutional analysts continue to issue strong structural warnings regarding these vehicles, noting that compounding friction makes them highly dangerous for long-term hold strategies, particularly during periods of post-IPO price discovery. In summary, institutional capital is treating SpaceX like a sophisticated dual-track approach. The broader market is insulating standard retail portfolios through strict index weighting rules, while active and synthetic managers absorb the immediate volatility. As public financial transparency increases over the next 4 quarters, expect the institutional footprint of SpaceX to expand significantly. Thank you, and we welcome you to learn more about our law firm's international financing and investment legal practice. And we look forward to seeing you again in our next update.